Welcome back to the Pike North Property Group YouTube channel. As always, we will be going over the Dallas-Fort Worth and Arlington market update. But instead of going on a field trip, I want to answer something that dawned on me that I think is really, really important, and that is the difference between what lenders look for commercial versus residential loans. So, interestingly, I went out and I did a video preview for a commercial building, and then a day or two later, I did a residential and open house, and it hit me. I was like, oh, you know what? There are a lot of people that don't know the huge differences between a residential and commercial loan, especially, where to get the money in the first place. So I put together a little bit of a chart that we're going to go through, and hopefully by the end of this, we've got quite a bit to cover. Hopefully by the end of this, you have a better sense of where to get started if that is something that you wanted to do in terms of, getting into commercial property. The following information is meant only as food for thought and is not financial advice. Always consult a financial professional to find out specifics for your situation. So we're going to look at the evaluation metric, and we're going to look at the common residential loan versus the common commercial real estate loan. So the primary buyer in a residential loan is you, the individual or the couple who's looking at a house and they want to go ahead and put an offer in. The lender wants to make sure that your finances, your financial history is of a low enough risk that they feel they can fund you. For a commercial loan, it's not you as the individual, it's the actual company, the LLC, the S Corp, the corporation. They're looking to see if the business itself is solvent enough. So the core metric for residential is the debt to income ratio and your W-2 and your personal tax returns. For commercial, it is your DSCR, which is the debt service coverage ratio. They're typically looking for 1.25 or higher. And then the primary risk assessment. So that's your, for residential, it's your personal credit score and your stable employment history. Commercial, it's the net operating income, it's the tenant leases, and it's the market viability, not your personal credit score. Like, will the market stay suitable for the business that you're in to survive long enough to pay off the loan? Down payment requirement is different on residential. It's anywhere between 3 and 20%, depending on how you want to address the PMI thing, whether or not you're using a VA loan or FHA loan. I talked about the VA loan specifically in my previous video, whereas the down payment on a commercial loan is significantly higher. We're talking 20 to 30%. Now, this one is huge. Loan terms. So in a residential loan, you're typically looking at 15 to 30 years. With a commercial loan, you can get anywhere from 5 to 25 years, but that's often with 5 to 10-year balloon payments or readjustments. And the underwriting focus for residential, it's personal financial health. With commercial, it's property valuation, rent roll, and business cash flow. So since we already covered a lot of what it takes to acquire a home in my Home Buying 101 guide, the video that I put together, look for that on the channel. I'm going to cover that quickly, but I want to focus more so on the step-by-step process for acquiring a commercial building. So there's preparation, pre-qualification. For residential, that means gathering your W-2s, your pay stubs, and getting a pre-approval letter based on your own personal borrowing capacity. For commercial, you're going to define your business goals. Is it going to be owner-occupied? Is it going to be an investor property where you have tenants? And you're going to have to calculate your business's net operating income and debt service coverage ratio. The application and document package, the paperwork that you're actually going to submit is going to be different between residential and commercial. So for residential, you're going to submit a standard loan application form, bank statements, and credit check authorization. For commercial, you're going to submit a comprehensive business package. That's going to be property financial history, current rent rolls and lease agreements, business plan, projection reports, and personal finance statements of business principals and guarantors. So how does underwriting and risk evaluation work? For residential, the underwriter verifies automated credit scoring, employment checks, and debt usage. For commercial, on the other hand, the underwriter conducts a manual, in-depth analysis of business cash flow. They're also going to evaluate tenant creditworthiness, lease lengths, industry trends. You don't want to be a VHS rental place applying for a new loan because the lender's going to think that your business model isn't going to work out for much longer. And the borrower's industry track record. What about valuation and due diligence? For residential, it's going to be your standard home assessment, the appraisal, comps, other home sales in the neighborhood. For commercial, it's multi-layered due diligence, commercial property appraisal, environmental site assessment, property condition assessment. And for loan structure, approval, closing, that residential is good to go when you get the clear to close. And it's usually going to be funded for a 15 to 30-year term. Commercial, on the other hand, is going to take a formal commitment letter issued detailing the loan covenants, balloon payments, or rate resets. And the closing is typically going to be with commercial legal counsel and escrow. So in short, residential loans are more about the person. What can you finance? What payments can you make? Whereas commercial is going to be more about the business. Can the business itself pay off the mortgage? So how is the debt service coverage ratio calculated? It's the projected net operating income over the annual debt service. And of course, that's going to be the principal and interest. So remember that ratio that I said before? They're looking for 1.25. So that's 25% over the annual debt service. Okay, so the question is, great. Well, how does someone who doesn't have business history or industry history or cash flow documentation get a commercial loan? How do you get started if you haven't done the business to get the business history in the first place? Well, let's say it's an empty building, but you know what kind of tenants you're going to go for. An independent licensed appraiser can perform a market rent survey of similar properties in the area and ultimately get a baseline income for the property. You can acquire a place that has existing tenants. This is when the building's rent roll comes into play because the lender is going to be looking at the cash flow and industry history of the tenants who are already in the building. Pro forma financial projections. So for owner-occupied buildings, the applicant submits a multi-year financial forecast detailing projected revenues, operating expenses, and margins. Guess what? You do kind of have to have some experience there so that you know those details because the lender's really going to be examining those details. You can use personal guarantees and global cash flow analysis. So in this scenario, the lender is going to look at what the business can gain in terms of revenue, and that is going to be supplemented or bolstered with the primary owner's personal cash flow. So it's almost like a guarantee from the cash that you have. So that way, if the property's cash flow falls short, the personal cash flow can come in and make up the difference. Small business loans from the SBA, that's a whole nother thing to look into in and of itself. Very useful, very helpful, but a lot to learn. And sometimes, higher equity. The borrower puts more skin in the game. We're talking about a 30% or 40% or even higher down payment to help the lender justify the risk. You can even do pledged escrows or reserves. And this is where the lender requires 6 to 12 months of principal, interest, taxes, and insurance to be set aside in an escrow account. And this mitigates the risk that the borrower can't pay because the money is already in an escrow account and will be used should the property not earn the revenue that it needs to pay the monthly payments. So as you can see, there are ways to get into commercial building acquisition. Now, I specialize in commercial buildings up to about 15,000 square feet because, it gets really complicated and the sky is the limit when it comes to the size of commercial buildings. So there you have it, the main differences between residential and commercial lending. All right, now let's get into the market report. Median list price is $450,000. That's down from the June peak of $455,000. The median price of new listings is about $420,000, which is down from about $440,000. Average days on market is back up to 100. In April, it was at 109, but it did get down to 98 in mid-June. And the median days on market is 63. In May, it was down to about 49. And the number that I always tend to keep a really close eye on is the percentage of listings with a price decrease. Right now, that's at 51%. Mid-April, that was 41%. And a stat that I haven't really tracked much on this channel, but I've been tracking in my head is that the median rent is about $2,400, and that's been fairly steady since about mid-May. So it's still, I would say, a balanced-ish market, but if you're a buyer, there's a lot of room to negotiate. If you're a seller, price competitively when you initially do the listing. All right, I've been Dalton. You've been watching the Pike North Property Group YouTube channel, and I will see you next time. I'm out.